Hi everyone and welcome. My name is Sarah Grantham. I'm with my colleague Anatoly Sorin, and we're talking to you today about the infrastructure lending landscape and what is actually happening. And this is all based on our most recent infrastructure lending report where we interviewed 200 market participants in Europe.
Yes, and this story is not that of a boom, more of a steady growth. 83% of the respondents see the market growing at a modest pace, so it's not overheating.
Yeah, and looking at the big picture, infrastructure lending is really in a different place today than it has been. We have private credit alongside the banks as mainstream, but the backdrop is really different. We've got high inflation, high rates, very uncertain geopolitical situations that are arising, and all of these factors are contributing to deal flow, and all of these factors are contributing to deal pricing and deal structuring as well. And I think it's important to note that two-thirds of investors did say that they expect moderate growth over the next period. And this shows that the demand story is still intact, it's still there, but it's a bit more disciplined.
So I think the key theme here is that it's a disciplined market, albeit it's much harder to operate in it.
Exactly. And returns are much harder to achieve as well. And that's why we're seeing focus more on deal structuring and not just the amount of capital that's being deployed.
And one of the main themes that we have been observing is the rise of the private credit lending in the infrastructure space. So drawing parallels with the direct lending market, the majority of the respondents, 81% of them, expect to see further growth in private credit in the infrastructure space. And that is expected to be incremental, not disruptive.
And 71%, just to support that point, also expect to see a shift away from bank financing. But of course, this isn't going to happen overnight. This is going to be over a period of years. And the reasons for that are really not just financial. 76% cited that it was due to better borrower terms. And again, 76% thought that it was faster decision making that was the real differentiator. So private credit isn't just winning on yield, it's also winning on execution as well.
There is also a lot of pressure on the returns. So a third of the respondents have highlighted the growing pricing as a concern, and also, on the other hand, a quarter have said that they're very concerned by the tightening margins. So it's the picture that emerges shows that the lenders are squeezed from both sides, higher hurdle rates, but also tighter pricing.
And this is then when you see innovation coming in. So we see it from the agency side. It's more creative, maybe complex structures, so hybrid structures or mezzanine, they're becoming much more common.
Well, it's all about preserving the returns, but also continuing to protect yourself against downside risk.
And what's really changed is where that risk is coming from. So now it's more political, regulatory, market risks, compared to previously it was just more traditional infrastructure lending risks.
It's interesting because that's a major shift, because it's so much more difficult to control for those risks using structuring alone.
And one thing that really stands out is that the discipline is still there. So 61% believe that covenants are actually balanced, and a quarter even believe that covenants are lender protective.
I mean, furthermore, 61% of respondents have said that the covenants have tightened over the last 2 years.
Yeah, and that feels really counterintuitive given the conversation around covenants in the market recently and also the level of capital that has been flowing into the market.
But again, it reinforces the picture of a disciplined asset class.
So in terms of where the capital is actually going, it's very thematic.
Well, the main themes are sort of defense and power transmission. Certainly, there's a lot of renewables, and let's not forget about data center build-outs. They've been the main themes for the respondents.
Yeah, and interestingly though, 50% actually believe that defense and renewables are overcapitalized. So the survey really picked up on this tension between opportunity versus too much money actually flowing into the same opportunities.
Moving on to another subject, one of the themes that we have picked up on, and this one is closer to home, is the evolving role of the agent in these transactions.
Yeah, so even though banks are still dominating at 52%, lending funds are at 37%, and as we've seen, they're here to stay, they're not going anywhere. And with that comes more lender diversity, and with that is more complexity in the deals. And that's where you really start to benefit from independent oversight and an independent agent.
The majority of respondents have highlighted that an independent agent can bring better transparency and governance to these transactions. especially as otherwise you might see a bank acting on both the lending and the agent sides.
Yeah, and actually 90% of respondents thought that independent agents will gain market share over the next 5 years, which again is something we're already seeing from a Nordic trustee perspective.
So stepping back, what does this all mean?
Well, for me, reflecting on the survey, it's really a market that is growing, definitely, but it's also becoming more selective and more complex.
So yeah, success it will be down to discipline, certainly better structuring and choosing the right opportunities.
And private credit, it's not going anywhere. It will continue growing, but this will be alongside the banks instead of them.
Exactly. It's not a disruption, it's an evolution.